Today, folks, we need to talk about the state of the stock market and some major updates surrounding my portfolio. There's an incredible amount of concern that the market is going to crash based on the political rhetoric, tariffs, everything going on in Canada, and we're already seeing secular crashes when it comes to quantum computing, AI. We're even going to talk about the real estate. I mean, what's crazy to me is companies like Pepsi, Constellation, a lot of consumer staples are actually dropping significantly into the beginning of the year, but I'm here to tell you, I'm not banking on what's going to happen tomorrow. This is not financial advice, but for my personal opinion, it's all fugazi. Everything that you think is going to happen tomorrow, you don't actually know. So I'm going to continue to buy stocks regardless, and I'm going to put a stock market emergency fund aside, a cash position, just in case the market dips by 10% or more. If it double-digit dips, I'm going to start doubling up my monthly contributions. And you guys know I get super aggressive when the market tanks, but I'm sitting in a precarious situation because I went so aggressive last year. I kind of drained my 6-month emergency fund, or my 6 to 12 month emergency fund, and I'm trying to build it back up because I got so aggressive paying down the mortgage. I got really aggressive buying Google and some other companies. So I'm just trying to readjust and figure out what my tax liabilities are, as I've already sat down with an accountant, and I am actually going to be sitting down with a CPA that used to work for RioCan that I'm bringing to this channel, hopefully in the couple coming weeks, so you can subscribe for that. But if you're on a path to financial independence, if you damn well one day want to retire early, you enjoy these conversations, go hit that subscribe, join me on that journey, because man, oh man, my portfolio is still holding up nicely, and that has to do with the weaker Canadian dollar. The Canadian dollar continues to get more and more suppressed, which even though the US markets are going down, the weaker Canadian dollar is bolstering those over-border returns for me, which get calculated in this spreadsheet. But I want to zoom in. Let's talk about my top positions, what I want to focus on, because I am going to be pivoting more to the Canadian markets with this now much weaker dollar. It's not going to stop me from buying US stocks, but I am going to be pivoting more toward the Canadian stocks, which makes up the smallest percentage of the wife and I's combined portfolio. But in the wife and I's combined portfolio, Google and Meta right now make up our two largest positions. Google right now, between our combined portfolios, and Meta make up about 12 to 13%. And I am sleeping ever more easier at night knowing these are our top weighted positions, because Google right now is crushing. It's up 1.1% since the beginning of the year. Meta's up 5%, which is really bolstering the weaker, VOO position that we have, which is down 1.5%. And if you want to go see Mark Zuckerberg, he was more or less just talking about the state of Meta's, obviously, conditioning when it comes to moderating comments and truth, kind of similar to what Twitter's done, or X. It's not the most engaging conversation I've seen him have, but hey, it's some updates. I've also got my Meta Quest here, which I think absolutely crushed the holidays. I mean, I know a lot of people that got some new Metas. I still use this thing religiously. Congrats, Meta shareholders, as we continue to crush Apple's endeavors into the VR space, which is not dying. I think there's huge future potential still in VR. But the reason I like Google and Meta so damn much is Google should be the largest company on the planet, first and foremost. If we take a look at the top weighted companies in the S&P 500 today, Apple has absolutely no growth. Their net income has started to fall off, yet somehow this company's commanded a 40 times multiple. When you take a look at the revenue, it's gone nowhere, right? Like, how is this company demanding so much? When you look at Microsoft, and I do want you to keep something in mind as we look at these, the net income. I mean, right now, the trailing 12 month, I mean, Apple's bringing in 93 billion. You look at Microsoft, it's bringing in about 90 billion. Nvidia is like, a huge, one of the largest companies. It's got the growth behind it, but it's still only bringing in 63 billion on the trailing 12. Amazon trades very close to Google in its market cap, and it's only bringing in 49 billion. But Google, I mean, this thing's bringing in 94 billion. It is bringing in more earnings than any of these other companies. It trades for a much lower market cap value. It trades for a much lower price to earnings multiple. It is a leader in AI and self-driving and healthcare and so many other futuristic things that I think are going to have huge potential. And the only reason I love Google, and the only reason you should pay attention to these companies, is they bring the attention to all these other companies. Whether you're Nvidia, Apple, Microsoft, your products need to be marketed, and you're marketing them through the Google platform. Google has launched mega brands as like Mr. Beast, and I just don't think people appreciate the severity of the value of that marketing, the margins of that marketing. Google should be the largest company on the planet today. They have, I think in receivables and cash, they're seeing like 170 billion or something stupid. Only next comparable company is Berkshire Hathaway with the size of the cash position. They could go buy an S&P 500 company tomorrow and just probably hugely bolster their value of the company. I don't understand how you value their cash position or where this company sits today, but I think it's worth more than a 25 times multiple, and the market is not appreciating it. And I think they're going to crush earnings, and we're going to see probably a 200 plus price target here very shortly. And I'm sleeping ever easier at night knowing these are our mega positions going into 2025 here. But yeah, I'm very much looking forward to seeing these two companies. I think Meta has a long runway with the underappreciation of how valuable and how easy it is to grow net income and returns in the marketing space. So that's kind of where we sit with Google and Meta. I'm not really going to be adding to these positions significantly, but I'd easily buy them here today. However, if we take a look at the rest of the market, and I really want to point out that it has been really peculiar because obviously AI has been crashing, and it's nice that people still don't consider Google or Meta these massive AI giants, which they are, but most of the AI hype stocks, the quantum stocks, are crashing right now. For some reason, Procter & Gamble and Pepsi are getting absolutely devastated, along with the real estate sector. And that's probably more in line to the lower interest rate cuts that are coming into the future for the US, which has been one of the primary hindrances to the Canadian dollar. The Canadian dollar over the last year is down now 7%. Over the last 5 days, very volatile, but from peak to trough here, it's still down about 1%. A lot of volatility in the currencies right now. But because of that, I'm more focused now on rebuilding our dividends, right? Because we've been kind of a balanced portfolio when it comes to the wife and I, with most of our assets sitting in the United States, which again, if you want to see how our combined portfolios look, go to my courses at kylelivingston.com. I'm going to be updating those shortly as well, adding some more material. And you can see a little bit more transparency in how I manage my parents' portfolio, what the wife and I do in our combined joint accounts. But we've been crushing it. Honestly, VDY has been doing very well, removing some of the volatility, even though it's a smaller weighting. I'm looking to buy a lot more of this along with some Canadian stocks as we look to bolster our average dividend yield to be around 3%. I'm not looking for 5-10%. I'm not chasing like option ETFs or anything like that. We just want a healthy dividend growth rate along with a more growth oriented portfolio. And we think we can achieve that with around a 3% yield. That 3% would literally, if we just pay the mortgage off, would float our property, and it would cover a lot of our base expenses at the scale that our portfolios currently sit. So I think in time, that's where we want to be sitting probably in the next 6 to 12 months as we continue to add to the portfolio. VDY though, I mean, it's removed so much volatility from the S&P over the last year, and it's one of the greatest positions that I'm very thankful to have, which is why, with the dollar being so crappy, I would rather be adding to that than maybe necessarily the S&P or Google. But I am also still looking at SCHD. SCHD is at a sizable position where I'm comfortable right now, and I don't want it to be much bigger. I want to kind of equal it between 20% SCHD, 20% VDY, because SCHD has actually been struggling comparably to VDY, which is very interesting. And it recently just kind of tanked quite miserably, and it led a lot of people to hate on it. But I still believe this to be a great dividend growth for us. Growth beast, and it gives me exposure to those consumer staples that I like so much, which we'll talk about in a moment. But also Aduro. Aduro looks like it's been crashing, and this has been my speculative play, but I think it's probably one of the coolest small cap companies that I own. I'm going to be adding to it. I want to buy a bit more in the clean tech space, and I'll talk about it more in the future. But this is the opportunity for those that said they were waiting for it to correct, to get in, because it corrects, but there's always people that seem to be buying it because I think they see the future potential in it. And it's been one of the greatest Canadian stocks over the last year in the realm of small caps. Definitely not trading in line with any other sector, which I find super intriguing. But when we take a look at some of those other sectors, like, I don't know what's going on here, but I mean, Procter & Gamble, Pepsi, Coca-Cola just getting devastated. In fact, Pepsi's paying the highest yield it's paid in its entire history. It's almost pushing 4% right now, which is staggering for the conglomerate that Pepsi is. And I'm very thankful it sits within SCHD. And I've got a drip set up, but I still might, when I top up my RSP, buy a bit more SCHD because I think the deals are still there. I think the discounts are still there. If you're into real estate right now, it is an opportune time because the interest rates still remain high. A lot of suppression in these markets that if you are in a retired state or you're looking to retire in the coming years, you've never seen yields like this in such AAA rated brands. I mean, we're still seeing the collapse of like Nestle, which I think has started to pop off a bit this year. Nestle, well, actually it's still going down, but Nestle and Hershey and a lot of these huge food brands have tanked on the back of what's going on with the cocoa and sugar markets. Cocoa, for those of you that are unaware, was the best performing commodity last year. And when I mean best performing, it's not a good thing. It's actually still holding record highs, and that's because there's been massive disruption in weather patterns where cocoa's grown. And same with sugar prices. A lot of the food industry is being largely disrupted by global weather patterns, and it's not a good thing for these companies. It's one of the primary reasons these companies are tanking. And I told you guys, if you want to play it, I would wait for a recovery in some of these prices or slowly cost average until you see a recovery, because that could bolster some of those stocks significantly, because Hershey, again, is mostly a sugar treat-oriented brand, whereas Nestle, they have a lot of exposure to sugar products and cocoa products, but they're like a multinational food brand. In fact, they were one of the largest up till recently when, you know, the crash started to happen for them. But like I said, where we sit today, I think we picked the best possible companies to own, and it's showing in the performance of our portfolios. And like I said, this is why I'm 100% transparent. I don't think I'm a genius. I think I'm a clown on the internet, but this clown has outperformed some of the best fund managers that exist. And I don't think I can do much better. I don't think I'm smarter than them. I don't think I'm smarter than anybody. And I'm hoping you can pull tidbits of advice and you're learning from this. And I'm going to do a live stream on Sunday, as I do every Sunday. So if you guys want to join, I'm going to answer a lot of your questions over the week that you left in the comments, because I do read them. So stay cool, stay awesome, and I'll catch you in the next one.